All right. I think Seema, Anthony, should we kick off now?
Yes.
So first of all, I want to thank everyone for attending. We are very, very excited to be doing our first joint webinar with Sensor Tower and getting an omni-channel read of both digital and in-store trends as well. So I'm Ed Lavery, VP of Financial Services, and Anthony, Seema, do you want to introduce yourselves?
Sure. My name's Anthony Bartolacci. I'm Sensor Tower's Chief Strategy Officer.
Hi, Seema Shah. I am the VP of Insights here at Sensor Tower.
Amazing. So over the course of the next half an hour, we are going to talk about various industry trends from fast casual and QSR. We're also going to talk about retail trends for seeing both the online, what's happening online and also in store as well. And then we're going to finish off with a bit of retail advertising as well. So how that's being done through apps and also through kind of in-store advertising too. So a lot going on, a webinar which is first of its kind. So we will kick off and just give a bit of introduction. So quickly, just a bit about Placer for those who aren't familiar. We provide foot traffic data. We're tracking traffic to every single location with a physical presence in the US, be it retail, restaurants, even offices and industrial. We're tracking a number of people visiting these locations. How do we do this? We're tracking a panel of tens of millions of devices, tracking their locations anonymously. We aggregate that data, extrapolate and normalize to provide estimations of traffic to every single location. And the kind of insights that we can provide is anything from visitation data to demographics data, so gender, age, household income, and even food preferences as well. Rankings, how often people are visiting these locations, where they go to before and after, and also where these visitors actually live as well. So we're used by multiple different industries, including financial services, retail, restaurants, commercial real estate, to even towns and municipalities who are using us for town planning. Seema, Anthony, sorry, got to hand over
Yeah,
to you.
no, cool. Thanks, Ed. And yeah, let me just say off the bat, it's really cool to be doing a joint webinar with Placer. I think so much of the power from these data sets is using them in conjunction with one another and being able to tell these more complex stories because you have, different lenses upon which to view consumer behavior. So I think it makes so much sense to pair the digital with the, in-store traffic that Placer's able to provide. But in terms of talking about Sensor Tower data, Sensor Tower's goal is to provide data across the entire digital economy. Obviously, we're starting with the Pathmatics side, which is our digital advertising business. Sensor Tower acquired Pathmatics 3 years ago. Pathmatics has a really cool lens upon which to view the entire scope of digital advertising. We have a host of panel assets that are able to gauge creatives and impressions of advertisements across desktop, video, OTT, social, mobile, really everything. And the advertising data becomes a really good arbiter of which brands are out there spending, what's their creative campaigns, competitive analysis. Obviously, advertising activity ultimately, will filter through to usage and engagement. And as you can see on the right-hand side, we're happy to provide more information as to the source of this data. And then on the mobile side, which is for a long time been the core of what Sensor Tower provides, we have a host of metrics that discern usage, engagement, downloads, in-app purchase revenue for mobile apps across the Apple App Store and the Google Play Store. One thing I want to flag at the outset is in March, it was announced that Sensor Tower acquired Data AI, formerly App Annie. So we are working very hard on the integration of both mobile data sets to provide a best of both and really a new standard as to how to understand consumer behavior across mobile applications. But for the the several data sets that are flagged here, we have our store intelligence product where we have download and revenue estimates across all the apps that participate in the Apple and Google stores. And then where we see a ton of interest is really on the active user and engagement side, which is found in our usage and consumer intelligence platforms, understanding active users, time spent, app overlap, churn, retention, These are all really interesting indicators to, better discern loyalty, and consumer behavior.
Amazing. Great. So I think as we're going to dive into our kind of our first sector, starting off with fast casual and QSR, it's around lunchtime in the East Coast as well, so no better place to start with food. Hopefully, this doesn't whet your appetite too much. Um,
All right, I'm gonna start off. Thank you, Ed. Looking at the digital side of the QSR space. So what we did is we took a look at the main types of proteins, essentially, that the different QSR retailers or restaurants have, and then took a look at how they compare to each other. So what we saw that was that 44% of MAUs within this cohort, so monthly active users, are actually coming from the burger chains. And this is an increase from the first quarter of 2019. At that time, pizza was a little bit stronger, and I think they probably saw a little bit of a boost over the pandemic. And as that's been cycling, that's decreased. And I think that they probably had less frequent mobile promotions than some of the burger chains, which we'll talk about shortly. But I think the other thing to note within burgers, the largest player is McDonald's with about 74% of the MAUs for the burger cohort. McDonald's MAUs are up 125% from the first quarter of 2019, and Jack in the Box is 138% from the first quarter of 2019. So it's been a huge surge and focus on mobile usage in the QSR space.
So I think what is actually very interesting when we're looking at the foot traffic trends, it's slightly different when looking at visiting physical locations. Burgers have been relatively stagnant, but the category that has really been improving has been chicken shops. So companies like Wingstop have been massively expanding, growing, increasing their foot traffic. So we're actually beginning to see this slight divergence on what's happening online versus what's happening in the store. Now, chicken growing, that might be partly due to people looking for cheaper alternatives as well. A lot of discounting that's been going on that side as well. So I think that's one thing to kind of bear in mind, this disparity, what's happening online in terms of food preferences, what people are choosing to take away versus the actual stores they're visiting. Regarding pizza as well, although similar story there, it's been a relatively stagnant space, but really that kind of growth, as I said, has been on the chicken side in terms of foot traffic.
So the next couple of slides, I'm just going to sort of take a look at McDonald's and its app and really how they've made it a core point of their advertising strategy in order to grow. So there's something called National Cheeseburger Day in September, which many of you may not be familiar with. But McDonald's had over 700 creatives over that period, significantly more than its closest competitors, which were 400 or less. So they really upped their advertising, and what they saw was a 21% increase in weekly average users on a week over week basis, and less than 12% for their competitors who didn't advertise as much. And so over this period, they had increased their ad spend by 23% from the prior few weeks, really to get their promotions out there on their mobile app and to get that customer interest so that eventually can have those transactions. So this is just the first example of really how McDonald's is making that push on their app. Can you go to the next slide? All right, so not only are they advertising food on their app, they're advertising their app. So I think with mindset, and just going back to what Ed said in the beginning, is omnichannel. Typically, a user that is involved with a brand or retailer in store and online and on its app tends to spend more and is a more loyal customer. So McDonald's is heavily promoting its mobile app with over nearly 400 creatives in the first quarter that mentioned the word app. So it's a big push, and you can see from the first chart multiple times more than the other burger chains. And they're also spending more than all the other burger chains, and they make up about a third of the spending with ad spending in this group. The other thing to note is just that if you're trying to figure out how McDonald's is actually performing, in the bottom chart, we just kind of show the relationship between Sensor Tower's MAU estimates and McDonald's share price. So you can see There's a high correlation here, and it's just something to keep in mind when you're thinking about how the company might be performing and how our data could be helpful in conjunction with Placer's foot traffic data. You go to the next. And then just to go a little bit deeper into promotions and to bring in the macro economy. So as we said, McDonald's continues to spend. This is just an example, though, of perhaps diminishing returns on that ad investment. So there's something called the winning sip promotion. And in 2023, when McDonald's did that, they saw an increase in their daily active users of 35%. Now, in 2024, they did the same promotion. They spent 26% more, but they only saw a 10% lift in their average DAUs. And so part of this, I think, could be, think about the backdrop, the economy. The CEO of McDonald's mentioned in their call last week that consumers are a little bit more pressured and more hesitant. And that's in the US, but we've seen similar macro trends in the UK as well. So I think you can see how much they've focused and emphasized in their app, but as we move on and we think about the economy, they might not get as much bang for their buck as they thought.
And I think that actually quite nicely tied into some of the foot traffic trends that we're seeing. Despite McDonald's spending so much on digital advertising, compared to its peers, McDonald's has been underperforming in the burger category. So visitation growth, particularly over the last couple of months, has been slightly weaker. So despite the big investment online, it's not performing so well on foot traffic. That said, in relation to the QSR industry overall, McDonald's is still beating its peers, but it still lags behind. One thing we're also seeing, and Seema, you touched on this a second ago, is consumers down trading as well. So one thing that we've noticed over the past year or so is a lot more kind of cross shopping from McDonald's to even grocery outlets or grocery stores like Aldi, for one example. So last year, the crossover of McDonald's visitors going to Aldi was 17%. In Q1 this year, it was 23% as well. So you don't have just down trading or discounting going on in the QSR space. Consumers actually going to grocery stores and superstores and even convenience stores as well to get lower price goods too.
All right, so now we're just going to move slightly out of QSR and talk about fast casual. And fast casual, we mean the Chipotles, Shake Shacks, Paneras of the world. And what we saw is that from first quarter 21 to second quarter 22, burger chains saw much faster MAU growth at 18% compared to a decline of 1% for the fast casual chains. But since that time and through the quarter to date, fast casual has really ramped up its MAU growth. It grew 36% on average for the past 7 quarters compared to just 15% for the burger chains. And we think part of that might be as we moved out of the pandemic and people were going out more, we also saw growth in the construction of actual physical locations of fast casual, from Cava to Panera, Chipotle, and even Shake Shack. And as we said, when you go into a market with a physical store, usually see a big pickup on the digital side as well, because they are often used in conjunction and they build brand awareness for both parts of the business. So next slide.
So looking at those kind of fast casual chains as well. So fast casual on foot traffic has been very strong performing as well. The big dip that we saw in January this year was due to the inclement weather that happened. So people are not visiting outside. But it certainly has picked up in February and March. Some of the other trends that we're seeing is that full service restaurants on the whole have been underperforming. People going back to kind of down trading as well have been picking cheaper options. That said, full service restaurants are performing well on kind of peak days of some sort. So whether it be Valentine's Day, Easter Day, people spending special occasions, celebrating special occasions, they're performing well. But on the whole, it's quick service restaurants and the fast casual restaurants have been the strongest performing on that. And within the category, both Chipotle and Shake Shack have very much been market leaders. A lot of the growth from Shake Shack has been through store expansion as well. They now have, I think, 300 stores in the US. And Chipotle has been pursuing a big growth. The other kind of key trends that we've been seeing in the fast casual space is time of day people are visiting. People are choosing to eat at Shake Shack and Chipotle later on in the day as well, which typically may have been more of a lunch item. People are now choosing it to have more of as a dinner item, 5 or 6 p.m. And a lot of that is driven from people working from home as well. So the growth from these businesses actually is being driven by a slight change of day, a time of day when people are eating out.
Just to pick up on what Ed said, I think the other thing to note about maybe people using fast casual for dinner could be a trade down from casual restaurants. Think of the Applebee's and stuff of the world, which have been under pressure for many, many years. And we've seen fast casual slowly take share from them. So I think it could be a portion of that as well. Here on this slide, we're just going a little bit of a deep dive into Chipotle and their promotion. So you'll see here on this chart, Chipotle has a promotion about once a month. When they do have a promotion, they see a huge surge in daily active users compared to a post-promotion period. But the problem is when they see that drop in DAUs, it essentially suggests that without a promotion, it's hard to get users. So they're not retaining the consumers that they've gotten from any one particular promotion, which in general just makes their customer acquisition costs higher than it might be if they were able to maintain, that retention rate. I think the other thing to note, and it goes back to what we said with McDonald's, consumers are pressured. So again, they're looking to where they have the deal, whether it be at fast casual, QSR, or even in the grocery store.
And I think what's interesting as well, we're seeing the same impact of promotions in store as well. So just taking a couple of examples, Arby's during the month of Lent were very aggressively pushing their fish sandwiches. And we can actually see on Fridays during Lent, huge increases in traffic to Arby's compared to the daily average there as well. So promotional activity is still driving that in-store traffic as well. And some of that is obviously connected to what's going on online through apps as well in general. We're also seeing a similar activity for another example, which is White Castle. So across the board in general, we saw huge peaks in traffic across all restaurant types on Valentine's Day as well. And White Castle really used Valentine's Day to kind of push traffic with a much higher increase on traffic on Wednesday, which is normally a very quiet day for the business. So promotional activity has been very much a key driver in this space. I don't know, Simo, is there anything else you kind of want to add to this at all? Should we answer a question now?
No, it's interesting that White Castle got a bump for Valentine's Day, actually.
Yeah, I'm not sure why
I was
that's a
just thinking
romantic
about
burger.
that, but now we can go to the next slide.
Maybe the burger's a bit more shareable than a regular burger, so
Perhaps.
slightly more romantic.
Yeah.
Cool. So we've covered kind of restaurant trends as well. We want to kind of give a bit of a view on retail trends as well. Now, retail trends, there's obviously two big dynamics that are going on. What's happening with the large superstores like Walmart, Target, Costco, and also what's happening with the giant e-commerce brands like Amazon and Temu and Shine as well. So we're going to be covering both of those in this section as well and look at the different dynamics on the offline market and also the online market too. So just kind of kicking this off. So a big key trend that we've seen in the past couple of years is a real big shift to membership clubs and also superstores. So brands like Costco and Sam's Club have doing very, very well. Target as well has also been beginning to pick up as well, providing a lot more kind of discounted goods and cheaper goods as consumers look to downtrade. So same trends that we're seeing in the retail restaurant space, but also seeing in the retail space too as well. And of the superstore brands, Costco and its membership and also BJ's and Sam's Club have been performing the best with the highest growth in Q1 compared to Q2. as consumers are really looking for value goods. There's also been this space has been very resilient. So as you can see, during the year, even with January being very much a down month due to people not wanting to go outside due to the bad weather, superstores have been pretty resilient to that as well. And even through the months of February and March, when department stores have been, although the decrease has been somewhat muted, superstores have still been growing. And this has been down trading, like consumers looking for value shopping, but also due to down trading as well from higher income households. Of department stores, Macy's has been shrinking. I'm sure a lot of you are familiar with the news that Macy's have been I think the Q4 earnings back a few months ago announced that we're going to be closing down a lot of stores as well. We can actually see this is partly driving some of the decrease in traffic, but also because consumers just haven't been shopping there. Kohl's as well has been suffering too. And if we look at some of the downsizing or the right sizing activity of Macy's, we can actually see some of the stores that they're closing are stores where there was a high overlap between stores. So Macy's is very much focusing on some of its largest stores as well, and ensuring the stores that are closed down have some form of overlap with its existing stores. So Macy's is looking for efficiencies during this phase where the department store industry is kind of losing foot traffic.
All right, thank you. So just to go on with this same line of talking, I think one of the things you'll see as you see physical retail shrink in different sectors is the hope of offsetting some of that through the digital world, either through their app or their website. But competition online is a little bit different than what we're seeing in store. As Ed mentioned, the Chinese e-tailers have come in and taken a significant amount of share from both the department stores and the wholesalers and mass, and think of like Amazon as the marketplace. They have grown significantly, as you've seen in this chart, and now actually Temu has about 50 million monthly active users. That's just below the 60, 65 million that Amazon has. So it's already 5 times bigger than Target and 2 times bigger than Walmart in terms of monthly active users. So that's a significant change in the competitive environment that we hadn't seen before. And you've probably seen their ad, Shop Like a Billionaire, but when we look at their ads, they emphasize a lot of keywords talking about saving money. I guess Shop Like a Billionaire, walk through and get whatever you want because you'll still be able to afford it. And that's clearly at least resonated in getting people's interest to try out these apps, both Shein and Temu. So you can go to the next slide. All right. But as I just said, it's not cheap to get all that growth. So Temu and Shein have the lowest percentage of organic mobile app downloads. In other words, most of their users are paid. So they are buying brand and mind share through advertising. But that makes their customer acquisition cost perpetually higher than maybe some of their rivals like Amazon, who has, more organic downloads than the average here that you see. Temu is about 30 percentage points below the cohort average, so really significantly having to buy a lot of the downloads as they continue to grow. Go to the next slide. And this is sort of the last part of this little trifecta. They are spending a lot of money on advertising, so they did get that initial download growth in total, right? Organic and paid. But where they're struggling, even though they have so many monthly active users, is maintaining that engagement. So partially you can argue it might be the macro economy and people pulling back from retail spending in general. But I think it's also that perhaps they're less satisfied with the experience that they have on there compared to other retailers, or they don't like the merchandise. So what they've seen is a decrease in duration and frequency of visiting the app relative to the greater sector. But the sector as a whole, stepping back from Temu and Shein, has been weak as well across the board. But So that's just something to note, that it's harder and harder for these retailers to maintain user interest and engagement. So it's costing them more to get them there in the first place. And then typically we would argue if someone is spending less time on an app, they're probably not shopping. Maybe they were going to get something they've previously ordered. So they tend to spend less and maybe a less loyal consumer. So I would just point that out. But then again, just to step back one more though, despite Shein and Temu seeing this decline, they are still have on an absolute basis the longest duration, about 30 minutes compared to like 10 minutes for Target and Walmart in terms of duration uh, of time spent on the app. So they're still doing well, but there is a decline as we move into Q1. Go to the next slide. All right, so we're going to talk a little bit about advertising. So Sensor Tower's Pathmatics data gives you a good view into digital advertising. We have a number of channels that we follow, from the socials to desktop to OTT. And what we can do is look at the different channels themselves, and we can also look at the different brands and advertisers and see what their allocation of spend is and how that might change from period to period and how that might be different than their competitors. So I would say broadly across the retail space that we've seen here with these retailers in general, the superstores and the department stores, Facebook is the channel of choice. So for the department stores, 50% of their ad spend was allocated to Facebook, with the next largest category being Instagram. So clearly Meta Platforms is taking the greatest share of ad spend in this space. And similarly, you see that also with the superstores and with the Chinese e-tailers, how significant it is that Meta has this, I guess, monopoly, I guess, on the ad spend. It is notable that TikTok doesn't have as much spend because it is growing rapidly on an absolute basis from a low base, but still you can see a lot of retailers are still not using TikTok. And were TikTok to be banned, we think that the biggest winners in terms of where shifting ad dollars would go would be to Instagram because of its Reels, which mimics the short form video on TikTok, or YouTube Shorts. Can you go to the next?
What about Twitter or X?
That's declining. That's all I'll say.
Don't advertise there.
Yeah, so just a little bit of a deeper dive into the clothing apparel retailers here. We have the 2 department stores, and then we have the Chinese e-tailers. Clearly, you can just see as you look chronologically, ad spend has really been lifted in total by Temu in particular and Shein. So giving the share of voice to Kohl's and Macy's, it's been shrinking over this period at a time probably when they need to have a greater share of voice to continue to attract consumers. So that's just something to note from this sector. And this is even in spite of Kohl's and Macy's increasing their ad spend. They're not increasing it as fast as the Chinese e-tailers. The next slide. All right, just a little bit deeper into Temu's ad spending. You can see from in 1 year ago, first quarter 23 to this year, they've significantly shifted their spending to Facebook. About 75% of their spend is now on Facebook, with 23% on Instagram. So again, very meta heavy. In fact, they've been advertising so much, they are the second largest advertiser on Facebook after Amazon. So they are really, really ramping up their spend as they go to try to expand and build market and mind share. So it's been working in terms of downloads, and it works in terms of MAUs. But as we've seen before, in order for any app or any retailer to keep that customer engagement, you have to go beyond the promotion. It needs to be the product or the service. And so that might be an issue going forward. And the last thing I would say is you could see a complete decline in the spend from YouTube, from 24% to about 1%. So pretty much have moved off of YouTube as a channel. Next slide. And this slide is just a little bit more on the superstores, just to highlight that not only is Amazon feeling pressure from Temu, which I believe they kind of mentioned not too long ago, but they're also losing ad share spend from the big box retailers. So we know that Walmart and Target are ramping up their services, their products, their private labels, and adjacent factors to make it more friendly for a consumer to come in, like the curbside pickup and whatnot. And we're seeing that in their advertising. Target in particular has significantly ramped up their advertising, and it's also ramped up its advertising also on TikTok, maybe to get that younger consumer, whereas Facebook's consumer might have higher disposable income and be more likely to actually convert. Maybe Target is trying to get a younger consumer before they've fully developed their shopping habits. So that's just something to note, that Amazon is also feeling pressure from the legacy retailers where it might have been ahead digitally than it is now. Next. And lastly, before I turn it over to Ed, I just wanted to talk about retail media networks. So at Sensor Tower, we cover a multitude of retail media networks in the UK and in the US, and you've probably heard about them in companies' earnings calls. Essentially, brands are advertising on these retailers' digital platforms, which they've previously done in-store as well. But now we are able to take a look at how they are spending on these retail media networks. And they're great for for the brands, because Target and Walmart already have that platform, and this is a high margin business. And for an advertiser, this is a way for you maybe to get a little bit closer to your end consumer. So just as an example, I just took a look at Walmart and Target's retail media channels and retail media networks and the allocation of spend for those networks. So typical to what we saw earlier, Facebook is the largest for Walmart outside of desktop display. But you can see for Target, TikTok is really ramped up and is now 32% of channel allocation. And then I have some stats here on the side for those that are interested. That Red Bull was the largest advertiser on Costco's platform in the first quarter with 24% of spend, followed by Procter & Gamble. But if we look at all advertisers across all the retail media networks we follow, oftentimes the largest advertisers are the retailers themselves that also have the networks. So I just thought we'd point this out. It's one of our newer products, and I think we're seeing a lot of retail move in this direction. So it's kind of interesting.
Super interesting. Super interesting what's going on there. So although at Placer we can't track how advertising is being done, we just rely on Sensor Tower for that now. What a lot of retailers are able to do is through their kind of own networks, understanding of the consumers who are going in, make sure that they're positioning the right products in the right stores as well. So one thing that they're using Placer data to do is better understand the demographics of people going into the individual stores. So, for example, Costco users, on the whole, preferences are for kind of chocolate, veggie burgers, and organic food, but less so for pre-cooked meals. And retailers on a store-by-store basis are able to use this information to make sure they've got the right product positioning and placement within each of their outlets as well. And then the other thing that we've also been tracking as well is using advertising campaigns to get people in stores on a particular time of day as well. So we're looking at Starbucks, using advertising to kind of get shoppers in at earlier times of the day or specific days of the week as well, and getting them to stay in longer. So Starbucks were using this on their Stanley Cup release, advertising that was going online to get people into their stores. And that's it. I mean, do we want to open up to any questions as well?
If you don't have any questions now, our contact information is here for both myself and Ed, and I can also connect you with Anthony. If you have any questions about either of our data sets or what we've presented here, or you want to learn more about it, please reach out to us. But otherwise, hopefully you've seen the connection between learning about offline and online, and why having these two data sets is actually super important to getting the big picture.